Hello everyone and welcome to today's video. In today's video, we are going to take a look at one of the basic questions that every trader, every investor has in their mind once they understand the importance of building a portfolio, that how many stocks should I have in my portfolio? And we are going to understand this with the practical example how the number of stocks actually helps you control your risk, helps you make sure that you don't have large drawdowns. So we're going to cover all the details. I would request you to stay till the end because I'm going to cover a lot of details, and in the end, we're going to kind of see a simulation to see what would have happened if you had the wrong number of stocks in your portfolio, and what actually happens if you have the right number of stocks in your portfolio when things start going wrong. So stay tuned till the end. And also, I would request you in advance, if you like this video, at the end of the video, please subscribe to the channel if you've not already done so, and share it with as many people as possible so that we can spread across the word and help more people become better at trading and investing. So a quick review as usual to see quickly what we are going to be covering in this video. I'm going to be discussing what should be your max position size relative to your capital, and here relative to the capital is very very important because different people start their trading or investment accounts with different amounts of capital. So based on that, you need to size your positions. You can't just have a single position size standard across the board. It depends on how much capital you're starting with. Then we'll see how risk is managed with this position sizing. We'll see a black swan event simulation, which is nothing but we're going to see how things work out for your portfolio if something drastically goes wrong. Let's say some company has really bad news and one of your investment loses a lot of money, then how things turn out and how we can basically control a big drawdown in our portfolio when such an event happens. We'll look at that. We'll also understand diversification, because it's very easy to start diversifying your portfolio and then become over diversified, which basically produces very mediocre returns. So we'll understand the difference and what needs to be taken care of. And also we'll understand the concept of the importance of maintaining quality investments and trades to be successful, because a lot of people, when they have cash sitting idle, they'll simply not want to keep it in the form of cash. They'll take some trade, they'll make some investment, compromising the quality of the trade or the investment that they're making, and that is really really bad. So we'll see how that works out and what should exactly be done. So I hope what we're going to cover in the video is clear. So for those of you who are interested, can continue with this video. I do this quick preview always at the starting of the video so that within a few minutes, once you click on the video, you know what we're going to cover. And if it really interests you, you can carry on, or you can go ahead and watch some other video of mine. So a quick look at the disclaimer. All information that I'm sharing with you is only for entertainment purposes. This is not any kind of trading or investment advice. If you plan to trade or invest, please consult your financial advisor before you do so. So let's look at the first concept, which is the max position size. Now, what do I mean by the max position size? Let's say I have a capital of $100,000, which I'm planning to use for trading or my investment purposes. Now, one way of investing this money is I can just buy shares in a single company with the entire 100K capital, right? That is similar to saying that you're putting all your eggs in one basket. If something goes wrong with that company, if that company's stock price crashes for some reason, then you're going to lose all of your money, right? So that is the concept of diversification, where we limit how much money is allocated to a single position. So if a single company, it makes a big loss, one of your investment takes a big loss, you still don't see a big drawdown in your portfolio. And this is where the basic question comes from. Okay, if I need to have more than one stock or more than one company in my portfolio, then how many companies ideally should I have? Is it two? Is it three? Is it four? What's the ideal number? So for most people, the figure that is going to be is 20. And why I'm saying 20 is we'll see that with mathematical simulation in a bit. But what happens when you are diversified into 20 different companies is that only 5% of your capital is allocated into every single position. So what I'm saying is, if you have $100,000 portfolio, what I personally try to do is not allocate more than $5,000 of that money into any single position. And we'll look at mathematically how it works out. Another thing to take note of is that with experience, as you trade more and more, This percentage can be varied, but for beginners, for people who are getting started, for people who've been trading for some time and are not experts, if you're not the Warren Buffett kind of person who understands the balance sheets and the financial statements really, really well, stick to 5%. But once you gain a lot of expertise, once you're confident that most of your investments or trading decisions work out well, then you can actually allocate the higher percentage, maybe 10%, to a single stock. And the reason is very simple. Diversification reduces our risk, but it also reduces our returns. So if you find some really good investments, ideally, you should put all your money into that investment. We want to select the best possible investment and then put all of our money in there. However, when you follow this kind of an approach, there is a huge risk that that best investment, if however small that probability of something going wrong with that best investment may be, but that probability is still there. So when things go wrong, then your portfolio will take a big dive, and we don't want that. So for beginners, for people with intermediate experience, stick to the 5% rule. That means you should have 20 positions in your portfolio. So whatever capital you have, I took the example of $100,000 capital. And if you have that kind of capital, don't allocate more than $5,000 into a single position, no matter how confident you are with the performance that you expect from that position. Okay, so no matter how strong your technical or fundamental signals are, make sure that you're not allocating more than 5% of the money to any single position. As your experience grows, then you can modify this percentage to increase somewhere between 5 and 10%, depending on the confidence you have on the trade or the investment that you are undertaking. How do we manage risk with position size? And in a very short span of time, we're going to basically look at an actual example, a simulation, how this risk is actually managed. The basic concept is that, let's say I am allocating 5% of my capital into every single trade, and I'm taking 20 trades at a time. So let's say one trade really goes against me, right? I lose 50% of my capital on that trade. That loss is going to be small enough that the rest of the 19 investments, the returns from those investments will be able to cover those losses. So essentially, we'll see that you will not experience a drawdown. All you will experience in that period, which could be a month, 2 months, whatever is your trading period, is that you are seeing a lesser return in that period. But you will not see a drawdown that most people see, because most beginners, what they end up doing is they invest all of their money in two or three big names. And when the market crashes, when something goes wrong with either of those companies, then their accounts are down by one third, maybe one half of the capital. I have seen people who have invested in very, very speculative Bitcoin stocks, because there's a lot of hype about blockchain. A lot of people going into EV right now because there's so much hype around EV. And I'm not saying there's anything wrong with that. But when you concentrate all of your portfolio or majority of your portfolio into that one position, which anyways is speculative, and the thing goes against you, your portfolio takes a nosedive. The most important thing, if you want to be successful in investing and trading, is that you should preserve your capital. Because understand, the capital that you invest is your asset, and you're going to be generating a return on the assets. So if I have $100,000 capital and I generate 3% or 4% return, I'm going to make $3,000 or $4,000 off it. If for some reason I lose that capital, let's say I lose half of that capital, right? I'm left with only $50,000. Then the 3% or 4% is only going to make me half the money. Now I'm going to make, at 4%, I'm going to make just $2,000 instead of $4,000 that I was making earlier. So at no cost, we want to increase the returns by taking a substantial amount of risk, which can put our base capital at risk. We need to preserve our base capital at all costs by as much as possible. Okay, so if you're starting with $100,000 capital, it's okay if your portfolio doesn't go to 120, 130, 150 in a single year, but you don't want to be seeing it at 60,000 or $70,000 at any time, right? We need to manage the risk so that the drawdowns are limited. So this is an example which I took, and in this case, the total capital being invested is $100,000, but the person who has this portfolio is investing in only into 5 companies. So every company is getting a $20,000 allocation. Now, when everything is going fine, the expected return on each of these investments, let's say in a monthly period, is 5%. Okay, so you can see here that on each of the stocks, the expected return is 5%. In dollar amounts, it's going to be $1,000 because each of the companies A, B, C, D, E is receiving an investment of $20,000. So you're expecting $1,000 return on each of the stocks, and totally you're expecting a $5,000 return on the $100,000 investment. So if you really think about this, the portfolio in this case is growing by $5,000 with a base capital of $100,000, which is nothing but a 5% return. So everything is awesome till now, right? Sounds very good, very, very nice return, and everything seems to be running absolutely fine. The portfolio seems to be diversified. There are 5 investments instead of a single one, and we are getting a nice 5% return. But let's say just one of these positions loses 50%. That means, let's say one of your positions was a pharma company, right? And pharma companies, they can lose a lot of their valuation very quickly because of an FDA rejection or something going wrong. Or let's say you invested into a company for whatever reason, the company A, it lost 50% of its value. So that position resulted in a 50% loss. Now, in this case, we can see here that on the first investment, we'll be losing $10,000. On the rest of the investments, we'll still continue to make $1,000 like before. We'll have a net loss of $6,000. So at the end of this period, what's going to happen is that my portfolio is going to be down to $94,000 because we just lost the $6,000. That means our return is going to be 6%. So 6% of my portfolio is down, and the next period onwards, I'm only going to have a capital of $94,000 to invest, right? And I just mentioned and explained some time back that preserving your capital is key, because the next month, even if you generate that 5% return, it's not going to be on the 100K. It's going to be on 94K now, which is going to be substantially lesser. So we don't want to lose our base capital at any cost. So this is when one position really went against you. Now let's see how we can. This is a simulation which we did. Here we had a portfolio which had 5 positions in all, but when everything was going fine. And here we had the same portfolio with the 5 positions, but when one of the positions went against us. Now let's take a look at an example. When we use the 5% rule, what happens then? So in this case, again, this is when things are going fine. But now, instead of investing in just 5 companies, A, B, C, D, and E, you're investing into 20 different companies. You have 20 positions. And obviously, the overall capital is still the same, $100,000. So the investment being made into each of the individual shares is now lesser. It's only $5,000. And as you can see, as long as everything goes fine, we're going to be making $250 in each of the shares. And at the end of the month, we're going to make $5,000 on a total investment of $100,000, which is going to give us a 5% return. And this is similar to the example that we saw earlier when we had only 5 positions. So whether you have 20 positions or whether you have 5 positions, the performance of the portfolio is going to be the same. You're not losing anything by diversifying your portfolio further. By having 20 positions instead of 5, you're not losing on returns. You are basically still making that 5% return when things are running normal, when things are working as expected. But now let's see what happens when one of the positions goes against you. That means the position loses 50% of its value. Now, understand that 1 or 2 companies can actually turn out to lose this much money. But when you select 20 stocks, chances of 5 or 6 companies doing and losing 50% of the valuation is rare. Okay, so we want to make sure that our portfolio doesn't take a big drawdown. So in this particular case, although the first investment, as you can see here, it took a 50% hit, because the investment was restricted to $5,000 only instead of the $20,000 that we made in the earlier example, the loss is only $2,500. And this loss is being covered or compensated by the returns from the rest of the investments. So rest of the 19 investments are giving me a profit, and the first investment is giving me a loss, but the returns from the rest of the 19 investments are good enough, are more than this loss from the first investment. So even though one of my positions went really against me as before, but because I have more number of positions, I still get a 2.25% portfolio growth. Now you can do the same example, thinking that okay, if you have 20 cases, maybe two investments can go against you. If two investments go against you, then you will make 2500 loss in two positions. That means your total loss will be $5,000, and total return from the rest of the 18 positions will be $2,000. So in that case also, if you see, your loss is only going to be $3,000, which is a 3% drawdown instead of the 6% drawdown that we saw earlier. So in both cases, even if more than one position goes against you, your losses or drawdowns in the portfolio are going to be much less. That means you have much better chance of preserving your capital when you diversify more. So this is the concept I want to drive across, that when you're beginning, make sure that you understand the importance of building a portfolio, because most people, they just go out there, they select the most popular companies, they have some money, and they'll go all in on one or two companies. And that is a bad way of investing, because when things go wrong, they can go wrong with the best of the best companies. Lehman Brothers, which filed for bankruptcy, was one of the premier companies at one time, with the entire world ready to invest into this company. Enron was the largest company and the most popular company in the world at one time, and then they filed for bankruptcy. So these companies will seem to be really good opportunities, and that is why people lose their money, because nobody can predict what's going to happen in the future. So don't try to predict the future. You need to make your trading and investment decisions knowing that there is the probability may be small, but then there is a definite probability, however small it may be, that things can go wrong with the best of the best companies. So once we plan our portfolio in such a way to account for these extreme unforeseen situations, then we can preserve our capital. Now, the next thing, which is very, very important, is to avoid over diversification. Now, what do I mean by over diversification? We just saw that instead of 5 positions, if we have 20 positions, then we have much better chance of preserving our capital. But somebody may extend this concept and say, you know what if I have 50 positions, I'm allocating only 2% of my capital to a single position, so in that case I'm even more protected. Well, that's not going to be the case. Yes, protection will be more, but then it has its downsides. So diversification versus over diversification, there's a battle between these two, and you basically need to have a balanced portfolio. I have a complete video around this. I'll leave a link to that in the description. So you must go through that to understand the concept if you're not clear with it. But diversification reduces our risk, but as we diversify, the effort that is required to make the trade or the investment and the returns, the effort increases and the returns basically come down. So what do I mean here? Uh, think about it. If you're trying to invest into 5 companies, those 5 companies could be the best companies in the world. But if you're trying to invest into 20 companies, you will have to pick up some companies which are not the best, which are just relatively mediocre, right? Because all 20 companies cannot be best in the world. So as you put a restriction that you have to invest into more companies, eventually you will have to include companies in your portfolio which are not the best, right? So when you're not investing in the best companies from as a plan, you cannot expect the kind of returns that you would get if you were investing only in the 5 best companies, right? So as you diversify, the returns become mediocre. But up till a certain point, the advantage of the downside protection or the drawdown protection that we get from diversification, as long as that exceeds the disadvantage of the reduction in the returns, we are good. But if you over diversify too much, to an extent that your risk is not getting reduced significantly, the drawdown risk is not getting reduced significantly, but your returns start getting affected by a lot, then you're over diversified, and that has to stop. So there has to be a balance between diversification and over diversification. And another problem with over diversification is that it's difficult. Let's say somebody's trying to invest $100,000 into 50 positions, then they have to come up with 50 companies, and chances are going to be that you will not be able to find 50 opportunities to put your money. And if you're not able to find all those opportunities, then what's going to happen is one of the two things. One, either your capital will stay undeployed, that means you will keep cash at hand, you will not be able to invest it, or if you forcefully invested, you will end up investing into bad positions which you should not have taken, and those positions can go against you. You can actually have losses on those positions. And also, for most of us, the brokerage charges now have reduced a lot, but it is more expensive because every time you have to modify your positions, you're basically going to incur slippage charges, you're basically going to incur brokerage charges and other things depending on which broker you are using. And so there is a certain cost to it. Moreover, a lot of time has to be spent in order to constantly analyze more and more stocks, because you need to have 50 positions at any time. So keeping all this in mind, I came up with the number 20. That is my rule, because with 20 positions, what happens is it allows me to reduce the risk as well, because I know that with my decisions, one or two trades that I select can go against me, but then most of the trades should work in my favor. And if that happens, then I don't have a big drawdown. I can easily make up for the losses within the same month, or maybe max in the next month. My portfolio will be back to its original shape. So that is one thing. At the same time, it's not over diversified. It's not that I have to do so much of analysis to understand and figure out more and more companies all the time, that I'm worried that most of my money is not invested, and it becomes a burden on me to identify so many positions. So always avoid over diversification. Make sure that you're diversifying your portfolio, creating a balanced portfolio, but at the same time you're not over diversifying. Now, in my video on portfolio management, I've discussed in detail how to create a balanced portfolio, in the sense that you're not just balancing in terms of having multiple companies, you're also having multiple sectors, you're also having different kinds of positions like combinations of longs and shorts. So you watch that video for more details around this. But the basic concept I want to drive across here is that diversification is good, but over diversification is not. And finally, we come to the importance of taking quality trades. And this is one of the reasons why I don't recommend that you should have 50 positions in your account, because although with the example and the simulation that I just showed you, you may feel that if only having 5% of the capital allocated to a single position instead of 20% can reduce my risk, then why not allocate 2% or just 1% of capital to every position? But what happens is you will not be able to find enough trades, and eventually you will end up taking positions in companies which are not really good companies, and we don't want to do that. We want to invest in the best companies, but then we also want to give some weightage to the fact that the best of the best companies can see bad times. And for those bad times, we want to be prepared that in case something goes wrong with the best of the best companies that we're trying to invest in, still our portfolio doesn't take a big dive. So I've already shown this with an example that with proper diversification, even if one or two of your trades go bad, then the overall portfolio is very, very resilient to a drawdown. You won't even notice that something went wrong. But if you're not properly diversified, then all of a sudden you will see that your $100,000 account is turned down into a 70,000, a $60,000 account, and that is very, very demoralizing. And moreover, when you lose, you have to understand that if you lose 50% of your capital, a 50% loss on your capital means you have to increase your capital by 100% to get back to your original position. For example, if you have $100,000, you lose 50% of $50,000, you're left with $50,000. Now, by investing that $50,000, if you want to get back to your original $100,000, you need to earn $50,000 more, which is nothing but 100%. So you need to make a 100% return on the remaining capital to just break even with your original capital, and that becomes very, very difficult. Okay, so always make sure that if you do not find quality trades or investments, keep your money parked in cash, because the cash is going to have the same value. It's obviously not going to grow, but then if you take bad investments or low quality investments, then you will see a reduction in that cash. And I'm mentioning so many times, your primary objective should be to preserve your capital. So hopefully this video was helpful, and basically I could drive across the point as to how many stocks you need in your portfolio. You don't have to have a huge number of stocks. You need to have a significant number of stocks so that you're diversified to a proper level. For beginners, it has to be, let's say, 20 positions. As you gain experience and you have more confidence in your analysis, then you can have 10 positions in your portfolio, and that is enough. So hopefully this video was helpful. If you find it helpful, please like the video, subscribe to the channel if you've not already done so, and please help spread the word. Share this video with your family and friends so that they too can benefit from this information. Thank you so much, and I'll catch you guys in the next video.